For generations, we have been taught that bonds are the ultimate safe haven, the boring, stable bedrock of any serious investment portfolio. And yet, from March 2020 to October 2023, the safest investment on Earth, long-term U.S. Treasury bonds, lost over 40% of their market value. The reputation of bonds as a sleepy, risk-free asset is one of the most dangerous and expensive misunderstandings in modern finance. The word bond is synonymous with safety, but as we've just seen, the reality is far more complex. In the next 10 minutes, you will learn exactly what a bond is, understand the single most important force that governs the bond market, and discover how to properly use this asset class to build a truly resilient investment portfolio. Let's strip away all the jargon. A bond is a loan. It is that simple. When you buy a bond, you are lending money to an entity, which is typically either a corporation or a government. In exchange for your loan, the issuer makes a simple contract with you. They promise two things. They will pay you regular interest payments over a set period. This interest is called the coupon. At the end of that period, on what is called the maturity date, they will return your original loan amount in full. This original amount is called the principal. A simple, clear animation shows an investor giving money to a government building and receiving back a certificate. Arrows representing coupon payments flow from the building to the investor over time. Finally, the principal amount flows back to the investor. The bond market is vast, with two main categories of issuers. There are corporate bonds, where you lend to companies like Apple or Ford. And there are government bonds, where you lend to countries. A U.S. Treasury bond is considered to have virtually zero default risk, as the U.S. government can, in theory, always print money to pay its debts. A bond from a struggling startup, a so-called junk bond, has a much higher risk of default. So, a bond is a simple loan. You lend money, you get interest, you get your principal back. It sounds perfectly safe, but this simple structure hides a powerful and counterintuitive risk that causes even safe government bonds to lose huge amounts of value. What is this force, and how does it work? This is the single most important concept in the bond market. If you understand this, you understand 90% of what matters. Theory. The interest rate. Seesaw bond prices have an inverse relationship with interest rates. When new interest rates in the economy go up, the market price of existing, lower coupon bonds goes down. When new interest rates in the economy go down, the market price of existing, higher coupon bonds goes up. Analogy. The rental property market. Imagine you buy a rental property for $300,000, and it generates a reliable $3,000 per month in rent. That $3,000 is your coupon. Scenario 1. Rates rise. A year later, the market changes. New, identical rental properties are now generating $4,000 per month. Your property, with its locked-in $3,000 rent, is now less attractive. If you wanted to sell it, you would have to offer it at a discount to compensate the new buyer for the lower income stream. The market value of your asset has fallen. Scenario 2. Rates fall. Now imagine new properties are only generating $2,000 a month. Your property, with its guaranteed $3,000 income, is now a premium asset. Its market value would soar. This is precisely how bonds behave. The rent is the coupon, and the rental market is the prevailing interest rate environment set by central banks. Example. Let's run the numbers. Today, you buy a 10-year U.S. Treasury bond. You pay the principal of $1,000. It comes with a 3% coupon. This means it pays you $30 in interest every year. Next year, inflation spikes, and the Federal Reserve raises interest rates aggressively. Now, new 10-year Treasury bonds are being issued with a 5% coupon, paying $50 a year. Your 3% bond is now obsolete. No rational investor would pay you $1,000 for your bond that pays $30 when they can buy a new one for $1,000 that pays $50. If you want to sell your bond on the open market before its maturity date, you must mark down the price, perhaps to $850, to make the overall return competitive. You haven't lost your money to default. You've lost market value due to interest rate risk. This is the force that caused the crash we saw in the intro. Understanding this dynamic is central to all areas of finance, from setting global mortgage rates to the wealth management strategies employed by every major insurance company and pension fund on Earth. Investors consistently make two fundamental errors when it comes to bonds. Pitfall number 1: confusing coupon with yield. The coupon is the fixed interest rate printed on the bond when it was issued. The yield to maturity is the total annualized return you will earn if you buy the bond at its current market price and hold it until it matures. If you buy that 3% coupon bond for a discounted price of $850, its yield will be much higher than 3%. They are not the same thing. Pitfall number 2: reaching for yield. In periods of low interest rates, investors get desperate for income. They move down the quality ladder, selling safe government bonds and buying high-yield junk bonds to get a more attractive payout. They fail to appreciate that the high yield is compensation for a much higher risk of default. It's like picking up pennies in front of a steamroller. Avoiding these fundamental errors is crucial for using bonds effectively. But there is a more sophisticated way to structure your bond holdings that professionals use to mitigate risk and optimize income. The advanced strategy: the bond ladder. Instead of making one big bet on a single bond with one maturity date, professionals often use a strategy called a bond ladder. It is a simple, elegant solution to the problem of interest rate risk. A bond ladder means you divide your total bond investment across a number of bonds with staggered or laddered maturity dates. How it works: if you have $100,000 to invest in bonds, instead of buying a single $100,000 10-year bond, you might build a 5-year ladder. You would buy 5 separate $20,000 bonds with maturities of 1 year, 2 years, 3 years, 4 years, and 5 years. Why it works? It mitigates interest rate risk. When your 1-year bond matures, you can reinvest that principal into a new 5-year bond at the end of your ladder. If interest rates have gone up, you get to take advantage of the new, higher rates. If rates have gone down, you still have your other 4 bonds locked in at the old higher rates. It smooths out your returns. It provides predictable liquidity. You have a chunk of your principal maturing every single year, giving you access to cash without ever having to sell a bond at a potential loss on the secondary market. A bond ladder is a disciplined, automated strategy that removes the need to guess which direction interest rates will go. For any investor seeking stable, predictable income, especially those in or near retirement, it is an indispensable tool. Let's consolidate this into the 3 foundational truths about bonds. A bond is a loan. You are lending money to a government or corporation in exchange for interest payments and a return of your principal at maturity. The seesaw is everything. The primary risk in owning bonds is not default, but interest rate risk. Bond prices have an inverse relationship with interest rates. When rates rise, the market value of existing bonds falls. Ladder to mitigate risk. The advanced strategy to manage interest rate risk is the bond ladder. By staggering the maturity dates of your bonds, you create predictable liquidity and systematically reinvest your capital, smoothing your returns over time. Bonds are not universally safe or risky. They are a tool. And like any powerful tool, they must be understood to be used effectively. If this analysis provided you with real value, invest a single click in the subscribe button to get daily access to the Codex. Knowledge is the new capital. We'll see you tomorrow.